TheoTrade. This is Don Kaufman. April 1st, 2022, an hour after the cash close here on this Friday afternoon, with the markets finishing the week, well, massively unchanged. I mean, for the most part, the S&Ps were completely and utterly unchanged on the week. And really, we're at kind of a crossroads right now, and it's a market of kind of indecision, painting real risk for both bulls and bears. Nevertheless, I'm going to explain that much more, but much more specific on this weekend's update. Once again, we are going to talk about how we are positioning for the forward future, and that's going to get into some specifics today of some positions that I have on, positions I'm planning to put on. Let's get to work here on this weekend's update. First and foremost, we could sit here and talk about a review of the marketplace, but what is there to review? So the market early on in the week shot to the upside, followed by some pretty wicked and unexpected sell-side activity on Thursday. And again, finishing the week, as I said, it is literally unchanged. A big donut here for unchanged inside of the S&Ps. To kind of review it just briefly in the Nasdaq, and again, I'll pull up auto expected move. It's probably the best way to kind of delineate this. The Nasdaq breaking to the upside of the expected move, and it finished the week mildly higher, and that's pretty much all it wrote. I mean, again, the IWM also relatively unchanged throughout the course of the week. The reason that I discuss how this paints kind of indecision, though, it's not about the equity markets, and we're going to jump right into it because this needs to be everyone's focus. I talked about this in Wednesday evening's video. All eyes are on bonds, treasury markets. All eyes need to be on bonds and treasury markets, because at this point in the game, that's where this wild indecision lies. The treasury markets, we talked about a crossroads a moment ago in the marketplace, but that crossroad is really, it's in the treasury markets. I mean, everybody at this point in time has probably heard there's an inversion of the yield curve, which I will discuss here momentarily. I'll display it momentarily. We're going to look at the probability of different rate hikes. Okay, so is the Fed going to, move rates up mildly? They're going to move it up massively. And of course, is the Fed even going to have time to tighten? Again, the inversion of the yield curve, for those of you that are unaware of this, often can signal recessionary pressures forthcoming. So when I say, hey, listen, it's indecision, for both bulls and bears, it really comes down, though, in large part to, again, the price action inside of the bond market. What is the bond market effectively telling us? So that's where I'm really going to kick off this weekend's update. Let's get right to it. What you're actually looking at here, it's a lovely website. It's the U.S. Department of Treasury. Oh, it could have been a more exciting site. And I am going to highlight for just a moment. We'll just highlight. This couldn't be a better day to discuss this, because here we are again. It's April 1st, and it's just so clean to be able to look at the data, and this is the yield curve, right? So this is your yield curve. And when I talk about like yield curve, there's different interest rates associated with different time horizons. You got 1 month, you got 2 month, you got 3 month, you got 6 month, you got 1 year, 2 year, 3 year, 5 year, 7 year, obviously, and up the curve. What often can signal recessionary, okay, for the most part, what they say is you're on the clock for a recession when right here, this 2 year starts to trade above, for instance, the 10 year. And well, that happened. And it even closed that way today. I mean, again, this is today's data, end of day data, but it is today. And we have, again, the 2 year sitting at 2.44, the 10 year sitting at 2.38. So at this point, no matter how minimal that inversion happens to be, it does effectively put you on the clock for what is supposedly a recession. And at this point, you kind of question, like, wait a second. The Fed has gone out, and what have they done? They've hiked. Okay, what did they hike? They hiked one time, a whopping 25 basis points. We have liftoff, and already the market is just downright freaking out. I mean, there's no other way to display it, you know? I mean, look, 2 years above the 10, we're going into a recession. It's like the market is screaming right now, you can't hike on me. Low interest rates forever. I want free money. It is like the new version, if you will, of a taper tantrum. Some of you will remember that phrase. The taper tantrum happened years ago when the Fed started to taper the balance sheet. The market absolutely panicked, threw a fit. Right now, the S&Ps are not throwing the fit. What's actually going on is the bond market's actually throwing the fit, and it's just warning the Fed, if you do this, if you really want to do this, okay, I'm going to invert the yield curve. We're going into a recession. And that's the way that I would look at that. And again, that's more of an opinion than reality. If you listen to, of course, Jerome Powell at this point, he'll tell you that the 2-year over the 10-year is not necessarily a recessionary sign. Nevertheless, I mean, look, you got a 2-year at the exact same rate. And this is just chaos, right? The 2 years at the exact same rate as a 30-year. So you can tie your money up for 2 years at 2.44, or you can tie your money for what? For the next 30 years. 30 years is 2.44. Oh, sign me up for that one. So the inversion of the yield curve is pretty serious. Now, at the exact same time we're saying this, I wanted to take you into, this is actually the CME group. Okay, this is a site in the CME group. It's the Fed Watch tool, and anybody can actually get on here, kind of explore this. It's not too often, I deviate on a weekend update and go to different sites, but I found this, well, shocking. After today's job number came out, jobs numbers came out. They're pretty good. 430,000, like 460 plus thousand were expected, yada, yada, yada. The market didn't even really move much on that jobs number. And again, but it was more good economic data. The percentage of unemployment dropped a little bit. But you want to see something wild? This is wild. And when I say this is wild, all right, what you actually have on this particular site, I'm going to try to highlight it to the best of my ability here so you guys can actually see it, playing the TheoTrade at-home game. The next meeting date is just over a month away. It's May 4th. And the probabilities are being priced in for even more than a 50 basis point hike. Okay, so we're talking about hikes. By the way, I have a personal issue even talking about hikes because, in the vast amount of my career, starting in 2008, they don't hike, they only cut. We've only had zero. Okay, it's hard to remember that, we're 14 years from zero. I know they lifted it off just a little bit before they put it back to zero. We got scared. Anyway, at this point, 75 basis point, 100 basis point hike is being priced in, and there's a 73% chance of it. It's insane, right? You're like, what? Okay, a lot of people didn't catch this today. So all of a sudden, a really big hike is being priced in. And that's why I said, you better be all eyes on the bond market. Then the meeting after that, they're actually pricing in, maybe we kind of play wait and see. The point that I'm making over here is there are just a number of hikes that are priced in, period. Doesn't mean we're necessarily going to jump 75 basis points or 100 basis points. But I would put it at this point in time, there is a very high probability, extremely high probability at this point in time, we're going to see at least a 50 basis point hike in the next Fed meeting, and that is only going to further invert the yield curve. Nevertheless, just a little bit about rate hikes and probability. By the way, when it comes to the probabilities and rate hikes, take it with a grain of salt. I was surprised by what I saw inside of the probabilities. When I say take it with a grain of salt, take it with a grain of salt simply because the next economic data comes out, for instance, like CPI, scares the market to death, and the probabilities flip the other way. It's very, very difficult to discern this far out from a meeting, but I would put the chances of a rate hike almost 100%, of course, but the chances of 50 basis point would be more significant. The next question you have in here, if they're looking at this and saying, well, the yield curve's already inverted, are they going to have much time to tighten? Okay, meaning that are they going to have much time to hike up the rates? Are they going to have much time to actually draw down the balance sheet before we actually do hit recessionary pressures? Every one of these statements that I'm making, you have to understand, has implications back to the S&P 500. The marketplace right now, it's almost like it's I wouldn't say ignoring the risk. I don't think ignoring the risk is the right phrase, but the market right now is simply screaming at the Fed, if you do this, we're going to invert. We're going to go into recession. They're going to take down the S&Ps a little bit. It's almost like the market trying to stave off the Fed at this particular point in time. Again, some pretty substantial moves, obviously, in the bond market. Big sell side activity followed by a rally. There was a huge sell-off this morning that we rallied back from. Okay, this one I cannot stress enough. Bond volatility, once again, it is through the roof. And probably the craziest thing that we saw today is that the notes actually moved more than bonds. So we're actually seeing more price action in notes in the 10-year than we are inside of the 30-year. And again, it's alarming to see this because in effect, it's actually creating, again, a curve that's just getting wildly inverted in a very short period of time. Again, forward implications. At this point in time, if there's continued sell side activity in the bonds, and I'll be as specific and explicit as I possibly can be with this. If there's continued sell side activity in the bonds, if there's continued sell side activity in the notes, that would be rates going higher. I would say unequivocally, it's going to take out tech. Tech is going to fall on that, and that's where that it's held up phenomenally at this particular point in time. So it's an area again of contention for the marketplace. I mean, what can you say right now other than well, Apple, okay, which is pretty much sitting at or near all-time highs. It's shocking to see that after everything that we've actually been through, where Apple is effectively sitting at or near all-time highs, and it's just one other aspect of the marketplace. We seem to be like brushing aside a huge degree of the risk. All right, with that, let's move onward and upward again. Enough on the inversion of the yield curve, rate hikes. Listen, there's going to be rate hikes is the bottom line. The only question in there is how many are they actually going to get in before the economy really does backslide? Again, rate hikes are not positive for the marketplace. I don't know how anybody can actually spin it that way. I know people are like, oh, in previous rate hiking cycles, this is not previous rate hiking cycles. This is commodity markets that are absolutely exploding to the upside. It's an inflationary, like hideous mess out there. Interest rates are sitting basically at zero. And the second we try to actually hike, we invert the yield curve. I mean, we hike 25 basis points, we invert the yield curve. Everybody goes, it's going to be okay. This is bullish for the marketplace. If again, that quintessential saying is don't fight the Fed, you're on the wrong side of the Fed. Let's start to talk about positions because right now the S&Ps, they're on thin ice. That's it. But let's position ourselves. Commodities and the dollar. As I was saying about commodities have absolutely soared. And I mentioned this a little bit live on TheoTrade, and I'll mention it again. The move inside of oil, okay, looks dismal in comparison to like the news that got released. 180 million barrels, okay, are coming out of the strategic, petroleum reserve, yada, yada, yada. Everybody's heard that news at this point. I think the shocking aspect is the underlying only moved down, 8 to 10%. It was pretty negligible. This was 1/3 of the entire strategic, petroleum reserve, and it only moved the market down nominally. Let's call it 7 to 8%, right? That is a little bit concerning because at this point, you've unloaded an absolute bazooka upon the oil market, and it laughed and just kept right on going. It's again, and I don't think necessarily a lot of people are looking at it that way. By the way, we're in wild backwardation. The wild backwardation has actually calmed down quite considerably. Again, the backwardation has calmed down considerably inside of the oil markets. Nevertheless, I have deep concern when the back end of the curve inside of oil is actually going up and the short end of the curve is actually going down again. It just doesn't paint a pretty picture for oil in the future. And after you go out there and you do 1/3 of the strategic oil petroleum reserve, after you basically, all right, we're going to give you 1/3. You basically pulled down your pants, you took off your shirt, you got nothing left in the tank now. And I do not like it. I don't have to like it. I don't want to like it. I'm telling you right now, oil is an extraordinarily dangerous marketplace. Unfortunately, to the upside. I think there's going to be incredible risks to the upside. It doesn't necessarily mean tomorrow or next week, but when it comes to commodity markets, people, this is far from over. There could be huge risks to the upside inside of the oil market. Again, they threw everything they had in there, threw in the towel, and it didn't calm this marketplace down. I mean, this oil, in my opinion, could have been down 15, 20 bucks easily on this news, and instead it's off mildly. Next in the docket here, home builders. So when it comes to home builders, we're actually going to look over at XHB. Now, I've got bearish positions inside of XHB. I wanted to display this. The reason I wanted to display this is home builders, okay? I have bearish positions. I would not I'm going to say this again, I would not bear up at this point in time. And I keep the bearish positions over my IRA, and I'm using longer duration bearish positions where I'm actually, I use deep in the money puts as synthetic short stock positions. I actually rolled pretty good sized position today in here out to the June expiration. In any regard, the reason I'm actually showing you the home builders is, everything from home builders. I also carry positions in a product like Home Depot. Okay, I'll display this a little bit. So some positioning specific to Home Depot, also massively deep in the money puts as synthetic short stock. Again, I'm not, telling you to put positions on, because why would you want to short into this deep of a hole? Okay, but for the other reason, like, why am I showing you this then? No, don't get into it now. I'm showing you the home builders because it's really the only sector that I can find that's like having true like negative implications because of the yield curve inversion. And that's a question mark. There's a question mark after that, because for the life of me, I can't understand how everything else is doing phenomenally. Like, I look at the financials and I'm like, historically speaking, financials and home builders, they've had a pretty good, fairly strong relationship. Not anymore. The yield curve inversion, though, can actually hurt financials. Even though interest rates are coming up, the actual inversion of the yield curve, a lot of trading firms can be on the wrong side of it. A lot of banks can be on the wrong side of it. And it's this is again is more of a question than an answer for you. But I would keep very, very careful eye on the financials specifically, because this is where, I was talking about indecision and, paints risk. The risk in my mind is coming in a big way to the financials, because the home builders are getting killed. And by the way, the home builders, I brought up XHB, and it includes Home Depot and a few others. Okay, the risk with a lot of the housing market lies inside of the financials. It just does. All right, another one I'm actually going to give you here is XLU, is the utilities. Inside of the utilities, I just took a position literally today. This one is I will position into, and if you look at this, it is a blistering move to the upside. This is kind of that quintessential move I tend to look for. It's two consecutive breaches outside of expected move, two massive breaches outside expected move. I am now in two different types of bearish positions. Number one, okay, I've elected to use an in-out spread. That's one strike in the money, one strike out of the money. Okay, when I put this position on, just to give you an idea, if you take a look at the XLU, yeah, that's us. 5,000 contracts per strike in the spread. So TheoTrade is moving markets. Want to see something really fun? If you actually look over here at option statistics, all 54,000 contracts almost traded on those puts. Obviously, we were substantially, 10,000 contracts of this, but we actually moved the put sizzle to double the norm. So again, going out and putting on a trade in there to actually move the put sizzle. So one of the positions that I actually shot out was an in-out spread, which is a short-term 35-day trade, just looking for a quick pullback in here. The other trade that I actually elected to do was a deeper. This one's interesting too. It's a deep in the money put as a synthetic short stock position. Okay, listen, I want to be in the XLU game, and I want to be in the XLU game for the long haul to the downside. Okay, because whichever way you want to look at this, blistering move to the upside, and everybody's going to give me 25 different reasons. It's duck and cover. We're getting into the XLU because it pays a dividend. I know the dividend it pays over here. Okay, I'm totally aware that it pays, 2.5% dividend in there. There it is. Okay, yada, yada, yada. That's not really going to impact me whatsoever. At this point in time, I'm actually shorting the utilities because what can rates do? Rates continue to explode up. It's going to take down the entire marketplace, right? That's going to pull off the XLU. Look at the marketplace in terms of volatility. When I say look at the marketplace in terms of volatility, the last time we got wicked, we got volatile for a substantial period of time is right here, the onset of COVID, and yet XLU had every ounce of volatility that the rest of the marketplace did. At this point in time, we've actually cracked into, and again, you have to pull up 10-year chart on here. This is it, people. This is all-time high. People are diving into utilities, which is a very defensive position. Okay, my argument is that utilities are actually going to be just as volatile as the rest of the marketplace. And the irony is that the utilities actually have about a 0.25 beta. So hey, take it or leave it. I like the position, although we may have to actually sustain this for a period of time, go through a little bit of pain in the near term. All right, so those are some of the positions that I just kind of got into. Again, financials. I want to be short. Utilities, I want to be short. The home builders, I already am short. I know what you're thinking. Is this guy long anything? I am. I'm actually long dollar. I'm long dollar because it's kind of duck and cover. Dollar looks like it's going to break out. Dollar's another reason. I wanted to actually loop back to this, but dollar is another reason why I'm a little bit nervous looking at the S&Ps. So you got the bonds that are all kinds of inverted, right? You have home builders which are getting absolutely annihilated. The financials are not getting annihilated. And the dollar, though, has kind of become the new VIX, and it's like poised. It looks like to break out. And again, if you actually look at a dollar chart, you back over 3 years, okay, the dollar, I wouldn't say it's going to be anything shy of 103, even 104. This thing's going to get downright wild to the upside. Why? Where are you going to go? Where are you going to go when the risk hits the fan? Think about it. You're going to go to the euro? Of course they're not. Okay, maybe you could buy Russian rubles. Okay, nobody wants those today. It doesn't matter where you think you're going to go. The world rushes into the dollar. And this is where people are talking about it's not going to be the reserve currency. It's not going to be petrodollars. Listen, right? There's no easy place. Nobody's going and jumping into the yuan. Anyway, I'm long dollar right now. And by the way, for getting long dollar, for me, the place to do that is actually over here in Tastyworks in the small exchange. Their small FX is actually a really cool place to actually get long dollars. Anyway, and last but definitely not least, we go to the SPX, the mother of all products. Again, I didn't want to spend a huge amount of time in this weekend's update talking about MACDs and Fibonacci's and Bollinger Bands when the bottom line is the indecision doesn't necessarily lie inside of the S&Ps or the Nasdaq, that the indecision is actually coming specifically from the bond market. You got to start to rationalize that every one of these data drops, whether it's CPI or, the jobless claims, so every one of these data drops is dangerous in this marketplace right now because those data drops can actually shift the bond market, which ultimately can cause some serious pain inside of the S&Ps. Anyway, one of the things you want to be aware of, volatility has definitely gotten crushed. We're back under, a 20 VIX, but taking a look at the SPX, last week's expected move was 88.65. This coming week, we dropped all the way down to 74.83. And this is the kind of price action where everybody starts to get off the game. They go, volatility's over, man, right? Listen, again, still a $75 expected move. Why do I care about that? That's the expected move. That means that the options market says we're going to go up 75 bucks or down 75 bucks. There's no directional bias to it. And the reason I say you better be on your game, you realize, we just passed through a fairly docile day. We moved 55 points in a docile day. Put your helmet on, people. There's a high probability of seeing some fairly wild moves in the very near future. Again, it's every one of the economic data drops is going to be an area of contention. Again, the market, indecision. All right, the indecision, it just continues to kind of paint risk for both bulls and bears. I think that there's some wonderful positioning that you can take right now. Be extraordinarily selective, okay? Keep some powder dry right now, a little capital on the side. Premium selling is hot. Skew is unbelievable. I mean, if you haven't looked at skew lately, we're back up to a 145 skew as of today. That is hot, man. It is extraordinarily hot skew. Again, premium selling is where it's at. But if you want to take directional positions, again, I showed you a couple there. Everything from dollar breaking out to the upside. Obviously, I'm still short home builders. The financials, I'm short. Utilities, I'm short. Sit back and wait for the volatility to come. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.